Hello, my name is Jingonelli, and today we are going to be looking at another tutorial. But before I begin off, make sure you subscribe to the channel. It will bring you some good luck in your forthcoming exams.
This is part of Audit of Inventory, where we stopped last time we met. So when you are auditing inventory, one of the activities you must perform as an auditor is to attend the stock take, or what you call inventory count. This is also called the stock take. So the physical counting of stock, when we talk about stock taking, okay, well, let's start. We are beginning from the physical inventory count. This is part of Audit of Inventory, where we stopped last time we met. So when you are auditing inventory, one of the activities you must perform as an auditor is to attend the stock take, or what you call inventory count. This is also called the stock take. So the physical counting of stock, when we talk about stock taking, we mean the physical counting of stock by the auditee allowed to attend that count, verify the existence of stock. You can only verify the existence if you attend. And ISA 501 allows you as an auditor to attend the count, but you don't count. It is the people at the client's place who are counting. Your work is to witness. So you must attend the stock count. You must witness the stock count to confirm the existence of that stock, because you'll be seeing it with your physical eyes. So that's why you say ISA 501, specific considerations for selected items, requires auditors to obtain audit evidence regarding the existence and the condition of inventory. You want to see, does inventory exist? In which condition is it? Is it damaged? Is it in good condition to be sold or to be used for production? So you must attend and witness. You only verify that by attending and witnessing the stock count. So when you count, what do you do? Or when you attend the count, what do you do? You evaluate the entity's inventory counting instructions. There must be instructions they're following. You're going to check whether they're following those instructions. Because if they move away from those instructions, they will end up not having the right count. But also you must observe the count or the counting, and you must inspect the physical inventory and perform test counts. So you do 4 things when you go to attend. Imagine you're auditing a supermarket like Capital Shoppers at the end of the year. They remained with some goods at the end of the year, what you're calling closing stock. But they want to know how much they are. So they will perform the count. So as an auditor, they should invite you to go and attend that count. When you attend, you first review the instructions they're going to follow. Later on, I'll tell you those instructions and confirm, are they following them or not? If they're not following them, you report. You write in your management letter. You observe the counting, you inspect the physical inventory, and you perform test counts. We're going to look at the explanations of all these 4 activities you do when you attend the count. Now, types of the counts. In cost accounting, they told you that we can count stock at the end of the year after the financial has ended, or we can count before or after the year end. Before or after the year end. But also, We can do perpetual counting. Perpetual counting means like you count every week or every month or every quarter. So perpetual is continuous. You find your counting before the year end. You're counting like every month, you know what's your closing stock every month or every quarter. That is called perpetual. It is throughout the year. So if we ask you this, you should be able to answer. Physical count, it can be done after the year has ended to see how many items remained, or before the year end, where you do perpetual counting, and it is done throughout the year. So when you attend this continuous count, what do you do as an auditor? You must verify that management maintains adequate records. If management counts, because for the perpetual, you not attend every day, every month, some organizations, they reconcile their stock every day, others every month, others every week, others quarterly. So the auditor will not go there every day. So what do? You must prove that they do that perpetual counting. They should give you the documentation showing that they counted, maybe every month or every quarter. So you must verify that management maintains adequate inventory records that are kept to date. If they count every quarter, then every quarter they should be having reports showing what was the closing stock at the end of quarter one, at the end of quarter two, at the end of quarter three, because you may not be able to go there every quarter. You may only be able to go in the final inventory count at the end of the year. But also, there must be adequate procedures for counting. E.g., they must be comparing sales and purchases transactions with inventory movements. How much was purchased? How much was sold in that period? Then you also consider opening stock. That gives you the right figure for closing stock. Then ensure that all inventory items are counted at least once a year by reviewing the count schedules. Then also attend at least one of the counts and investigate and correct all material differences, but also review the investigations and adjustments they are making in the stock records. Sometimes you find stock was stolen, so they must do investigations. So review the adequacy of those investigations to find out how stock was stolen or was misplaced, and then also the adjustments they are making in the records of stock. So these procedures here we are seeing are procedures which you conduct in case they are doing in case they are doing a continuous inventory count. Desire, can you mute? And Aisha, can you mute? Desire, please mute your mic. So these are the procedures you conduct in case management is doing continuous inventory count. One, you must verify that they do it by looking at all that. You must attend at least one count. You must investigate and correct all material differences. And then you must review the investigations that are being done for lost inventory and also the adjustments they are making. Now, we said that when they are counting the instructions they must follow, these are instructions which are followed while doing the inventory count. One, the process must be supervised by senior independent staff. For example, if inventory people, warehouse people are counting, then the finance manager can supervise. The person who is independent of stores should be one to supervise the process. Why? Because people in stores already know what the mess they have done in that store. So there should be an independent person from different departments come and supervise the process. You'll be able to ask them where are these things not tying up with what is in the records. You get it. So that is one of the count instructions they must follow. You as an auditor just come to verify, are they following these instructions? Then what they have finished counting, they should mark it. they should mark inventory. Some organizations have a lot of inventory. The store is so big. If they don't tide and mark what they have already counted, they may end up repeating. I already shared the notes. You check your e-learning platform, the notes are there. I think the course leader passed the information to you. So the notes are there on the e-learning platform. You get them. Then during the count, there should be no movement, because if you keep moving stock from one place to another, you end up double counting it within the store. So during the count, there should be limited movements of stock to avoid double counting. Imagine you're counting stock in a warehouse. Inventory is in one location, you count it, but they move it to where you haven't counted. You go and count it the second time. So that will be double counting. That's why we want limited movements during the count. But also, if there is stock which is damaged, obsolete, or slow moving, it should be identified and removed from the inventory which is in good condition. Because this one is recorded separately, the damaged, obsolete, slow moving, and returnable inventory. Then also, if we have inventory for other people in our store, for third parties, we should also mark it and separate it, because if we don't do that, we shall count it as our stock, yet it's not. So you as an auditor, you're coming to verify where all these are being followed, whether all these instructions are being followed. Also, the counting instructions should be documented and communicated in writing to the counters. The counters must know these instructions so that they follow them. Then count teams are independent of the warehouse or department, so that they are able to detect any mishaps in the store. If you leave the store people to count their own stock without putting independent people, and then they will not know what was stolen. They're the ones who stole it, so they will report the figures which are higher. They will not tell you what they stolen or what they was stolen or what they misplaced, because they don't want to be implicated. Yeah. So that's why we're saying that bring in independent people, get people from other departments to come and formulate count teams. For them, they'll be independent of stores and they'll report what they will find on ground. Then senior members of the team are allocated to count high value items. In case they're high value items, they should be counted by senior members of the organization. They're the ones who should count. Then we should also note the dates of the GRNs and GDNs and make sure that items of a different year are not brought in the current year or are not counted as stock of the current year. So those are some of the instructions, how you organize the account. This is how you organize the account. So as an auditor, you prove it is not, these are not your instructions as an auditor to follow. They are instructions of the accountants of the organization you are auditing. So your work is to review them, to review these instructions. If they are inadequate, then you advise them to add a few or to remove. Then during the count, what should be followed during the count? The count should be systematic. What we mean here is you should be having a starting point and an end point. You should be having a starting point and an end point. You don't just count haphazardly. If you've started with stationery, count it and finish it before you go to another item. If you've started with pipes, count them and finish them before you go to another item. That is what I'm meaning by systematic. So don't count from the beginning of the store, then you first go at the end, then you come back to the middle, then you first count 2 items in stationery, you leave it, you go and count another one, like that. So there should be systematic counting to ensure all inventory is counted. Then counters are assigned specific areas. If the warehouse is so big, and there are many different types of stock, you should assign each counting team a specific area. Then 2 counters per team, one counting and the second one checking the count and recording. So there should be at least 2 counters in each team. One counts, another one records. One counts, another one records. That we hope in having accurate figures. I've already said you mark items you have already counted. You flag them up. You can put a flag or you mark them. Also, the bin card should be updated during the count. Bin cards, that is the card that shows inventory that has been coming in and moving out and the balance. So on that day of the account, you should capture the balance that is remaining physically, and you update it, and the counters sign on that bin card, and also the internal auditor who is supervising, for example, also signs with his purple pen. So the second count by different teams or sample counts by the supervisor should also be done. I said systematic counting is all about counting one area completed, count one item of inventory completed, go to another. Or start from a given point, follow that line, count all the items in that line, finish them, and also go to another like that. You don't keep jumping. You count one, you move to another place like that. Then, so the counting should be in order. Should be order like somebody has answered there. Then, recording. When you are recording what you are counting, what do you follow? You should record on sheets, inventory sheets. We record on inventory sheets after counting. And these sheets should be serially numbered. They should have serial numbers. Those serial numbers help us not to misplace those sheets. Because if they are not numbered, you can record on one sheet and you lose it. There are 5 sheets, you remain with only 4. You will not even know that you lost the 5th one. But if they are numbered 1 of 5, 2 of 5, 3 of 5, 4 of 5, 5 of 5, if one is missing, you will know that one is missing. So the sheets should be serially numbered. That's an internal control. You talked about it during the inventory control topic 4. So the inventory count sheets, that's where we record what we are counting. And you, the auditor, are going to check whether they are serially numbered and they are accounted for after the count. Being accounted for means that if there were 5, yes, all the 5 are there. If the pages are 5, all the 5 pages are available in the file. Also, these inventory sheets, they should also only indicate inventory codes and descriptions. They shouldn't be filled. You shouldn't fill them before you do the count. They should be blank. They should only have the code, inventory code, the descriptions, then the amount. For example, if it is stationary, you can have code. If the code for toner is 001, so on that sheet you can fill in. You can print when that one is already filled in. The toner is 001. Description, you describe it, but on this side of the amounts should be blank. The amount should be blank, so that you only fill in when you are counting. If you fill in before the count, then that will not be a count. So that they shouldn't be pre-filled or filled before the count. Why? Some people use that because they don't want to count. They just want to fill in what is in the system, and during the count, they are not having the correct figures. So that's why we are saying that the inventory count sheets shouldn't be filled before the count. Should just print them when they are blank. They are only having, for example, even the inventory names you can just fill in when you are counting, so that you can fill in the accurate figures which are physically there. Because the purpose of the count sheet, of the inventory sheets, is to capture the actual inventory which is there, the physical inventory. So when you fill them before the process, you will not have the correct picture of which inventory is actually in the store. So that's why we're saying that they shouldn't be pre-filled. They should be filled during the count. Then also, the other instruction is that the quantity, condition, and stage of production of work in progress are recorded on the sheets. So the quantity just record using a pen. So these sheets should be filled in using a pen. The condition in which an inventory is in and the stage of work in progress all should be completed in ink. And then inventory sheets are completed in ink and signed by the counters. After the counters have counted the stock, they should fill in ink and sign off. We said that there should be 2 counters. So each signs. Also, the supervisor can also sign, the one who has been supervising the process. And also the internal auditor who has been maybe also overseeing. So all of them should sign, confirm that those people attended the count. Then you, the auditor, is to check, did all those people sign? If you find that they never signed, then there will be a problem. They may not have counted, they may have just filled in the office and they didn't actually do the physical count. That's why we want all those people to sign after they have done the count. That will show that the count was conducted. And so I'm going to show you a sample of the count sheet here, so that you appreciate what I'm talking about. So like that one can be a sample of the count sheet: item, description, quantity, and location. So you must show us where is the inventory, what's the item number, for example. You describe it, then you put the quantity. So these ones shouldn't be filled in before. I hope you can see it now. It should be blank like this. It should be blank. I just fill in using a pen. Should be blank like that. Those are the inventory count sheets. Then, so they should be filled in ink, completed in ink and signed by the counters. Then it should be, after that, these counters should take the sheets to the supervisor, who checks the sequence of all sheets at the end of the count and compiles all of them together, because you might have like 10 teams of counters. So after they have counted, they should hand in all those sheets after they have signed to the supervisor, who checks the sequence of all sheets. Are they following each other? Are they numbered properly at the end of the count? Then also during recording of after the count or during the count, this recording can take place during the count. So recording last numbers of GRNs and GDNs and internal transfer records. When you record the last GN which came in and GDN first and last, it will help you not to remember. GRN we said is the document which receives goods purchases. GRN, goods received note. If goods were received, for example, on 1st January, then those goods are not for the current year. Then If goods were sold on 2nd January, then those goods are not for the current year. They were there. They were in closing stock. They were there, then they're just being sold in the new year. So these dates help you to show you whether the items purchased came in before the year end, or those sold, they were sold after year end, not to overstate closing stock or understate it. Then you also do the reconciliation with inventory records and investigation and correction of variances. So reconciliations are very key. Reconcile these documents, the inventory sheets, the bin cards, the what is in the system. So at the end of the day, you're going to reconcile what you've counted and what is in the system, or what is in the stock ledger. Remember stock ledger and cost accounting. The stock ledger is filled in consistently in the system or physically. So there are figures in the stock ledger, but there's also figures you've counted. Are those figures matching or not? So you're going to reconcile. But also where you have made some investigations of lost stock, of other issues, you also reconcile them with what you have witnessed during the count. So these are the instructions. Practically, if we are going to conduct the count like next week, the client sends us these instructions. It is the client who develops them, what they're going to follow. They send them to us like a week or a month before. As auditors, we look at them. If we think they're adequate, we approve them. If we think there's something missing, we suggest it and incorporate it in. Then, when the count is taking place, we Gandhi and check whether they're following all these instructions. Where they're not following, we ask them why they're not following and record it as a finding. Any question on that? The instructions are not in order. These instructions are not in any order. Somebody is asking whether they are in order. They are not in order. You can restart by writing any. If they ask you some examples of stock count instructions that a client must follow. Any other question? Has anyone ever attended the stock count? You can share with us your experience. During your internship, you have not attended any stock count?
No.
I attended.
Okay, you tell us what happened.
Like when we used to put like stickers on people's products. So they will tell us that the sticker, the last sticker that you put should be removed off, like the commodity. You remove it off and then you leave it on a side, and then you get the new product. You start counting from that new product, including the last one, so that you can count. You can get the exact number of the values you've obtained.
Okay.
Excuse me, sir.
Yes.
Should I take it that the auditor has no right to draft the instructions of the count?
As per the standard, you are not the one who drafts them. It is the client, but the client can also request you to draft for him or her. So if the client requests, you can draft for them.
Okay.
Yeah. Any other experience? Can somebody tell us any other experience they had during the count? Were all these things being done? Somebody saying, I have attended the stock count and we went to logistics and counted the items left for the previous year so that it can guide what to purchase for the new year. We had a list we were using. So, but before you use that list, you first have the stock count sheets. You fill in the physical stock. Then you compare with the list afterwards. Then somebody is asking, Marion, do we consider closing balances? We count what has remained at the end of the financial year. So if the year is ending 31st December, we must count on 1st. So on 1st January, the count should take place. Because if you count after that date, then many items will have moved. So we normally count either on that last day of the year, 31st, or on 1st January to get the actual figure of what remained in the store at the end of the year. Somebody carried out stock in the bonded warehouse. We attended an recording. Any other experience? Those who have attended the count? Okay, so we continue. Now, before the count, now we are going to have audit procedures before the count. Before you go to attend the count, what did you do as an auditor? So we're going to look at audit procedures before the inventory count. Now, first, you're going to get the previous year's management letter. You as an auditor. Last year, they did the count, but which issues were on inventory count, on that count? You find last year, maybe the count, some count instructions were not being followed. And that was documented in the management letter of the previous audit. So that's why I'm saying that review the previous year's working papers for the problems faced and discuss with management major changes that have taken place during the year. So which problems were there last year during the count? For example, you might have faced a challenge like of there were no bin cards were not updated last year. The count teams had only one person who was counting and recording, which may be a problem. Somebody may not record the correct amounts. Maybe last year there was no internal auditor supervising the process, or the process was only conducted by point warehouse. There were no independent staff. So those problems that were there last year, they were documented in the working papers of last year, your audit working papers. Have they now been resolved? So that's the starting point before you even go to attend the count. Have they resolved those challenges in the previous year's audit? If yes, which changes have they put in place? Are the changes adequate or not? So they send you the records, you review them. That's an inspection test. But also, you get a copy of the instructions which they are going to follow in the current year. And these instructions I've just looked at. Review them. Look out for any deficiencies and discuss them with management. Advise them, tell them, yes, you are saying you are going to conduct stock on 5th January. But after 31st, 5 days, a lot of stock would have moved. So can't we start earlier? Can't we do it on 31st or on 1st? You find in the instructions they're saying that they will not go to some branches. You tell them, but how will you confirm what's in those branches? So in the instructions, you advise them on the adequacy of the instructions. They must send you a copy. But also, you as an auditor, you must understand the nature of inventory. Is this inventory, does it need an expert? You are an auditor. Will you understand it? It might be inventory in a hospital, which you may not understand, or inventory in an engineering firm. A farm using it's a chemical farm. They use a lot of chemicals. You don't understand those chemicals. So understand the nature of inventory you're going to count. You as an auditor, do you understand it? You might reach there, and the chemists are doing they're giving you the names of those items and you don't understand them. So they can first even send you the list of the stock in their store. You make research, you do research on it and understand every item, or you go with an expert who understands it. Then also, you obtain a list of all locations of inventory. Before you go there, you must know that the locations. Where is it located? How many branches? so that you try to attend most of the counts, because they count at the same time at head office and in the branches. So you establish the locations and you make sure that you attend all, or you pick the major ones where there's likely to be risk, those with huge values, you attend those ones. Now somebody is asking the difference between stock count and board of survey. A stock count only focuses on stock. And we all know stock. Stock is raw materials, work in progress, is finished goods. But a board of survey, for it involves physical inspection of assets, stores, cash, books of accounts, and so all those. For board of survey, we are counting everything. We are doing a physical inspection of everything. Physical inspection of assets, of stores, that is stock, of cash. Some companies keep cash, of bank balances, of books of accounts. So that's the board of survey. It's bigger than a stock count. For it, you're counting everything in the organization. You're physically inspecting everything in the organization. That is board of survey. Then, before you go for the count also, you assign audit staff who will count at the head office, who will be in branch A. So you assign your audit staff and give them locations, but senior people should be assigned to high value items. By the way, some companies have very expensive stock. You find one item is costing like 13 million. One item is costing like 100 million. So that item is susceptible to risks. It can easily be stolen. So there you send senior staff to go and witness the count of those high value items. Then these other junior auditors have just joined. They can go and attend the count of small value items. Then arrange to get confirmation from third parties of inventory held. In case they communicate to you that some of their inventory is with third parties like agents and distributors, you arrange on how to get confirmation letters from those people, confirm that they hold that inventory. So those are some of the of what you do, you as an auditor, procedures before before the count. Review the previous year's working papers, review the count instructions, understand the nature of the inventory, allocate your staff, get to know where inventory is located, get the allocations and the volume and the high value items, and then arrange to communicate with other people who are holding these clients' stock. Then during the count, what do you do? During the count, you open your eyes and observe the count and make sure that they are following the instructions. Then 2, you perform test counts. Test counts will mean they are counting, people are counting. They will not even mind you, the auditor. For them, they just continue with their work. So for you, just come, you stop them, you tell them, you are counting, here you're counting stock. Which stock you're counting maybe stationary, which has remained at the end of the year. You're counting pens, boxes of pens. You tell them to repeat for you. You say, of course, what did you go with as an auditor? You go with the list from the system. So you can go with the list from the system. You say, repeat for me that count of pens. They count. They find 200 pens. But on the list for you, you have 190. So you're going to get that as there's a difference of 10. They have counted 200, but on the list in the system, there's 190. So test counts, you can just come from the document, from the list, from the inventory list or sheet. You tell them to count again what they have already counted. Also, even inventory sheets, you find they have already counted something. They have already counted 5 items. You get take me to this item and count it again. They will count it and you confirm whether it matches or not. But also you can start from the physical, just moving around the store, they are counting their things. Then you reach an item, you stop, you call them, say, physically here I'm seeing you count again. They count for you, they count 10 items. You ask them the record and check whether they have recorded what? 10. So that's how you perform test counts. Inventory sheets to physical inventory or physical inventory to inventory sheets. The first one is for existence. You start from the document they have recorded. You take them back to count for you again. To confirm what they have recorded on the sheet is what is there. Or you start from the physical, just randomly, and then you see what they have recorded on the sheets. That's during the count. Also during the count, you check whether damaged items are being segregated from the inventory in good condition. Damaged stock, slow moving stock with issues. Sometimes you find stock with issues. Maybe they returned it has issues. All those types of stock should be segregated from the stock which is good and kept separately. So during the count, you identify that. Also during the count, you confirm that there are no unnecessary movements of stock. But of course, some companies must continue operating. They still move, but when they move, at least they record them. They update the bin cards that they have moved out this item. But the movements of stock to and in the store should be. That's why we count on the last day of the year or on the first day of the new year before they start moving again. In fact, some organizations, what they do on that day, they first close the store. They don't allow people to take out things or to bring in on that day. But if it is inevitable, they can do what? They minimize those movements because they will lead to double counting of stock movements in and out. So they first close off the stores on the day of the count and they complete it. But of course, there are exceptions where they can't wait. Those ones can go on, but they should be minimized. So we must observe whether the movements are minimized and all the movements are taken note of, not to double count. But also you must obtain copies of inventory sheets. So they are counting, as you said, there are two people on each team. One is counting, one is recording. So after they have counted and they have signed, you tell them to photocopy for you those sheets. You go with them, you go with your copies. They should photocopy for you. You go with your copies, you follow up with them later. Then during the count, you also identify inventory held for third parties in the store. It should be kept in a separate place and marked. And also you identify and make a note of last GDN and GRN before the count date in order to perform cutoff test procedure. Which goods last entered the store? It will be on the GRN, showing the goods that last entered and the goods that were last removed for sales, so that they don't put in goods, or you don't record. If goods came in on 2nd January, then those goods are not for last year, they just came in. It will be showing on the GRN. But if the GRN is saying 31st December, then those goods, even if they haven't come physically, but they are goods in the closing stock. So what are we saying during the count? Observe the counting and confirm instructions are being followed. Perform test counts. Damaged goods and the returnable and slow moving should be separated. Movements are minimized. You check that, or you observe. Also, you obtain copies of inventory count sheets and all that. Any question on that? Then after the count, what do you do? After the count, we have looked at before, during, and after. So after the count, we said that you get copies of inventory sheets. So use them after the count. So after the count, you're going to trace items that were test counted to the final inventory sheets. Remember, you took them back, they counted for you, you recorded in your working papers. Then ask them the final inventory count sheets. Now, this is what happens. When they are recording, when they are counting, they record on the inventory sheets. Then after that, they transfer that information to the final inventory sheet, the final one, after they have all counted and the supervisor has gathered all of them, and he makes a final list for all the stocks, and they also give you a copy. So, for example, you had taken them back to recount for you toner under stationery, and you confirmed that they were 10 items. So you come to this final list and check whether they're actually 10, items. So you trace the test counted item, the final list. Also, you inspect whether all count sheets have been included in the final list. Because I said these separate sheets, count sheets, are the ones we transferred the final inventory list. So since you said that you get copies of those sheets, then you're going to test count, to test, you inspect whether all. So you go one by one and check it has been posted in the final list. Inspect the final list, inventory list, to ensure it is supported by count sheets. They should not just get these ones from the system or from their heads, but they should be coming from the final, the count sheets which they used, which they recorded during the count. Then also inspect whether inventory records are adjusted to reflect physical count and the variances are investigated. So when you're counting, this is what happens. You're going to have a document like this. You're going to have inventory. You're going to have the details, the number. You can start with the number. The code. Let's call it the code. Then the details. Then you have the inventory. Count sheets. You have the bin card. We can call this one the physical count. Physical count. The bin card. Then the stock ledger. This is now the system. The system can be electronic or physical, but where they keep updating every day when stock is issued or is received. Remember, in cost accounting, that stock ledger, it will be showing you the number. Then you're going to have the final inventory list, and then the variance. Now, what are we saying? We're saying that code, for example, inventory is 0011. Details, this is toner. Physical count, you counted. Maybe this is in packs. Physical count, they counted 10. Bin card is showing what was left. This is what now the closing stock. What was left is 10. This can be what's called a reconciliation report. The reconciliation report. What was counted 10. Bin card is also showing what? 10. Physical there is 10. Bin card is also showing 10. In the system, there's 12, yeah? Then this figure here, the physical count on the inventory count sheets. Here we have the inventory count sheets. Inventory count sheets. They are the ones which are supposed to be transferred to the final list. This one here. So in the final list, of course, they have taken. They assuming they have taken the correct figure 10. But now the system still has 12. You get it? So the variance is 2. The variance is between the stock ledger, this one, and the final inventory list. If I can call this one A, so it is between these two to get the variance. So the variance you find is what? Is 2, like that. So They must explain this. Here, there should be a comment. What is causing this what? Variance. Is it because they haven't updated the system? Is it because those items were stolen? You get it. So what is causing that variance? They put a comment. So you, the auditor, you're interested in these variances between the stock ledger and the physical count. Physical count is 10, but the system is showing 12. So these variances are normally caused by sometimes the delay to update the system. Sometimes they've stolen the stock. So that's why it's not there physically. You get it. So
Recording in
calculating
progress.
amounts you're calculating, if it's recalculation, if it's inspection, which records are you inspecting? Which assets are you inspecting? You must mention them. For example, if it's external confirmation, which information are you obtaining from the other person? So, for example, write to the bank to obtain information about the closing balances of the client, the accounts he holds. You get it? That's the description, yeah? The records you are trying to look at, the information you're trying to obtain, yeah? And then the assertion you are testing. So you should keep these audit procedures as brief as possible, provided you capture the documents you are inspecting, the amounts you are recalculating. You get it. Is that clear? The person who was asking?
I think it's clear.
Okay, so there is no much, you do not write paragraphs of 10 lines of 8 lines. They are unnecessary here. In fact, that booklet of 28 pages, half of the booklet is enough for you to get a 90. Because we used, for example, like in topic 2, a question on topic 2, you're using tables. A question on topic 3, asking you audit risks and responses, a table. Ethical threats and safeguards, a table. Deficiencies in internal controls and the consequences and recommendations, a table. So half of that booklet is enough for you to score a 90. Just write the correct things. Don't over-explain these things. The way you see these answers, the way they are here in the notes, that's the same way. Just say compare. What are you comparing? I'm comparing opening balance of PPE and closing balance. From where? Tell us where they're from. Which assertion are you testing? So those are like 2 lines or 2.5. What am I recalculating? I'm calculating the statutory deductions on the payroll. What are they? Pay and NSSF, yeah, from the payroll. What am I inspecting? I'm inspecting the asset register. You get it? Where you must use a table, you must use a table. Because if you must use a table and you don't use it, then you'll be making the work of the examiner hard. So where you must use a table, those questions of tables, you must use it to make the work of the examiner easy. Otherwise, he may not see some of your answers. So key takeaways on audit of inventory. We said that there is the stock count, witnessed by the auditor. Then the documents, we said the documents you must keep in your mind is inventory count sheets, which led to the final inventory lists. We have the stock ledger or list from the system. We have said we have bin cards, which are kept. We have the stock count instructions, which must be reviewed. Instructions. We have damaged stock, slow moving stock, or returnable stock, which must be separated We have inventory for third parties. And by third parties. We have talked about the getting confirmations from third parties. We have talked about test counts. So those are some of the key things you must remember. While you are auditing what? Stock.
Excuse me, sir.
Yes.
Under what circumstance would an auditor not attend like a stock take?
For example, if the company is very far and you can't go there, the stock is very far and the logistics don't allow the client is not providing transport, even the fees you have agreed upon can't allow. But also during the pandemics like COVID, we weren't able to attend some of the stock. So what we were doing, we were depending on the reports. We would request for the final inventory lists and the account sheets and the report, the final inventory report. So basically, if there is like a pandemic like COVID, but also if the client has not organized, has not informed you, has not invited you, and you've tried to tell him to come, but he's not allowing you to go there, or even when you don't, the resources are not allowing, you get it. But ideally, you should be attending.
So how about on a scenario where the stock is immaterial? Is it still necessary for the external auditor to attend the stock count?
You may not attend if it's immaterial. For example, you see like now, these service businesses, like you're auditing a law firm, you're auditing a consultant's firm. Their stock is still material. You find they only remained with 2 reams of papers, with a few pens. That's their stock. So now that's when you not attend. It is the material. Yeah. So procedures are before, during, and after the count. So that is stock. We've got audit of receivables, repayments, and revenue. These ones are audited together because revenue leads to credit sales lead to receivables, but also prepayments are also captured under. You remember IS1, trade and other receivables. So prepayments is also receivable. You received money in advance. So what are we saying? We audit these ones together. And revenue is considered a very high risk area. So why is it high risk? Subjectivity and recognition of revenue from long-term contracts. When you go to IFRS 15, you find that the way we arrive at the revenue we're going to recognize, there's some subjectivity. For example, you remember step 1 of IFRS 15, you identified the contract. 2, the performance obligations. 3, you allocate the price. You determine the price, then 4, you allocate, and then 5, you recognize revenue when goods are transferred physically to the customer. Now, on data allocation, for example, you are allocating revenue to the main goods sold and maybe the after-sales service. There can be some subjectivity there. On those long-term contracts, we may be subjective on the unit price of the contract. You get it. So it is risky. Somebody is getting 100 million from the contract, but is only reporting 90. You get it to the organization. Also, there is complexity, like IFRS 15 itself, like those following those 5 procedures. It's complex. Not all these people can follow it properly. So they may end up not having the correct figure. They may wait to recognize revenue from invoices, yet they're supposed to recognize it from GDNs. So they may not recognize some of the inventory during the year. Some of them don't know that in accounting we use accruals. We recognize even before we receive cash. So you may find somebody has not recognized some revenue because he's waiting for the cash, or he has followed the invoice date instead of the GDN date. So he ends up taking it to another year. Also, some revenue can be unrecorded, which makes it hard to follow up. So all these reasons and others prompt us as auditors to put much emphasis on auditing revenue. But also somebody can steal the money, and if he steals the money, he will not record that one as revenue. He will try to remove it from the system. Also, some people may want to show good performance, so they add in sales which never occurred. You get it. So there are many risks of revenue. That's why we audit it. What do we audit on revenue? It is an item in the income statement. We said we audit assertions of COCAP, that is completeness, occurrence, accuracy, cutoff, classification, and presentation. Those are the audit tests we conduct on revenue. We want to confirm whether all the transactions for revenue occurred or happened. Why? We want to make sure that there's no fictitious revenue being recorded, or the revenue has been recorded following the GDNs. Completeness, accuracy, cutoff, right period. As I said that some people don't know accounting, they wait for the cash, so they record in the wrong period, or they wait for the invoice, yet they are supposed to use the GDN date, so they end up recording the wrong period. That's why we need to perform the cutoff tests. Now, which tests do we perform? We start with analytical. Analytical is so simple. You get the total revenue of the current year with the previous years. So you compare analytical. Compare the total revenue of the current year with the previous year. You want to find out whether there are any significant fluctuations in that revenue. If the trend is decreasing, revenue is decreasing for the company, then there's a problem. Revenue shouldn't be decreasing. So you are comparing with the previous years and the budget to confirm whether we are still hitting our targets concerning revenue. And if there are huge variations or huge declines, then you as an auditor, that's a point of concern. So fluctuations can be increases or decreases. If revenue has decreased, then there's a possibility that maybe there's fraud, or some revenue has not been recorded in the correct period. That's why it is decreasing. Or you find, so incompleteness, there's incompleteness, yeah? If you find it has decreased, that may be a sign of incompleteness. Either they have not recorded all the revenue in that right period. Some revenue has remained unrecorded, they're waiting for the receipts or invoices, yet they're supposed to use GDNs. You find that maybe they're stealing the money, that's why they don't want to recognize it, or they want to dodge some tax, yeah? But also if it has increased with big margins, we need to confirm whether actually all those transactions were there. But they may just be doing window dressing. They're overstating that revenue intentionally to show good performance, yet it's not there. So you compare with the previous years and you investigate all those huge fluctuations. You ask management to tell you what brought them. Then you will ascertain whether they were genuine or not genuine. Now the second test is it is still this one is still analytical. You compare the gross profit margin for the current year with the previous year and investigate any significant fluctuations. If the margin is reducing, then there's a problem. So as an auditor, you will investigate that and find out why the profit margin is decreasing. And we say that the margin can decrease because of inflated prices of costs, or we say that decrease in the margin can be because of, why does the gross profit margin decrease? I remember saying it here. We said gross profit margin equals to sales minus cost of sales. Cost of sales is opening stock plus purchases minus closing stock. Now, if inflation or inflating purchase prices understating closing stock, selling products, selling at low prices may lead or leads to decline in gross profit. So as an auditor, you want to know, are profits increasing or decreasing? If the profits are decreasing, what could be the reasons? This could be the what? The reasons. The procurement department may be inflating the purchase prices. The item is 2,000, but they're buying it at 2,500. They're eating the 500, yeah, per piece, yeah. That one reduces the profit of the business. So that one will be your finding. I'm going to tell us that the profits have declined compared to the previous year. Why? When you're writing your findings, eh? Why? Because this may be because of inflated prices. Now you go back to the invoices and see how much did they pay for a given item? What was the market price at that time? It will be evident that they have paid more amounts than what they were supposed to pay. So you see how you start your investigation. First thing you investigate, eh? You first compare. When you compare, it shows you where the problem is. Eh? You compare gross profit margin of the current year with the previous years. Eh? If you find that it has reduced, you go ahead, you go to the source documents then. You see, they bought an item at 2,500 per piece. But on the market at that time, what was supposed to be the what? The price. If you find the price was supposed to be 1,000, then the prices were inflated by 1,500. That is possibly why the profit is reducing. And you write that on as your finding. So your finding is there's a decline in the gross profit margin compared to the previous year. You give us that decline, maybe a decline of 70 million. What are the likely causes? Inflation of purchase prices. You say I reviewed, for example, invoices of item A, B, C, D, where the items were paid for at 2,500, yet the prices in the market at that time, or the quoted prices, one supplier had quoted 1,000. So there's a risk that they inflated the prices, and money was maybe misappropriated. That's why the profits are declining, yeah. But also you go back to the stock we have just been on stock. You confirm whether it was not understated, because if stock is understated here, profits will also be understated. You review the selling prices. Remember, in the entity there is a price list. There's an approved price list. If you're auditing, for example, you got chick, they sell chicken. They have their price list. How much do they sell the certain pieces? Eh? If it's a wing, how much do they sell the wing? How much they sell the kilogram of chicken? They have their price list. The drumsticks, how much they sell a kilogram? They have their price list. But if the person is selling sells below those price lists, gives the discounts which are not approved, then the profit will go down. So you also go and investigate the prices of the products. It will be confirmation that they have done that. But also, there could be a possibility of overstating gross profit. So gross profits, overstatement of gross profits may be due to overstatement of closing stock. It can also be, it can be also just be fraud. They have just mechanically changed the figure. Mechanically. They just overstate the figure. You get it in order to earn bonuses and others. So what are we saying? The test is calculate the gross profit for the entity that's in the current year, compare this to the previous year, and investigate any significant changes. What are you trying to verify? Completeness, accuracy, and those other assertions. So those two tests are analytical procedures. We have compared the total amounts and then the ratio. The ratio for revenue is gross profit. But you can also compare the net profit. You know the difference between net profit and gross profit. Now, the other tests, now this one is which test? We're saying obtain a schedule of sales for the year broken down into many products categories and compare. This is still analytical, as you can see compare here. So you're going to get a list of sales. Schedule of sales is the list. This one should not confuse you. Some of you may not be knowing the schedule. List. Get the list of goods sold during the year. The list of sales for the year. It should be categorized as per the product and compare those to the previous year. If you are auditing Crown beverages, get a list of sales of Mountain Dew, of Mirinda Fruity, of Pepsi Cola for the current year. Then you compare with the previous year. See which product is having decline in sales, which one is having increases in sales. Those unusual big movements should be investigated and find out why you get it. So we are comparing total revenue, current year, previous year, and the budget. We are comparing, getting a list of all sales, comparing the previous year per product, then the gross profit margin. And then the next test is an inspection test. The first three are analytical, but you can add other analytical. You can add other analytical as I guided you last time. You can also do a trend analysis like for the last 5 years for sales. You can analyze the sales account for any unusual postings there. You get it. So we go to inspection, agree a sample of GDNs to the sales invoices. So you mark at this movement from GDN. Remember, GDN is the document which sells goods. IFRS 15, goods are sold when they are physically transferred to the customer. So GDN is prepared when we are transferring the goods. So compare a sample of GDNs to the sales invoices. Because from GDN, we prepare an invoice and trace the sales invoices to the revenue account and the general ledger accounts to verify the of revenue. So this is a simple one. It's an inspection test from the source documents, GDN and invoices. You are agreeing them to the revenue ledger. RL is revenue ledger. Or sales what? Ledger. And the general ledger. Sales ledger is the for the individual accounts, for the individual products. Then general ledger has the total sales. Are all invoices posted to the ledger? So if you find that all invoices have been posted to the ledger, then there is completeness. Are all GDNs posted to the ledger? That is what you're trying to find out. So that's why you select a sample and match them with the ledger. You should be ticking this one, yes, this one is there, this one is there. If you find out that is missing, then there's no completeness. Fred and Shakira, please mute your mics. Then next is, so here, select a sample of sales in the ledger. Now we are just reversing this test. We are reversing this. Select a sample of sales in the ledger, and then inspect the supporting what documents like invoices and GDNs. And outside RL is revenue ledger, then GL is general ledger. revenue ledger, general ledger. Revenue ledger is same as the sales ledger. You know, from source documents, you post the journal and then the ledger. But no, sometimes we just skip the journal because journal doesn't have any double entry. So we focus on where double entry is, which is the ledger. So that's why we see me here skipping the journal. It doesn't have double what? Entry. The double entry is in the ledger. So we reverse that test for occurrence. You now select a sample of transactions from the ledger, the general ledger and the sales ledger, or even journal. Then agree them to the source documents. You want, because source documents shows that the transaction happened. So I'm starting from the ledger, move backwards, confirm that there's a source document for every transaction in the ledger. That will confirm that that transaction occurred. But in the first test, when I start from the document, the source document to the ledger, I'm checking whether they have recorded all of them in the ledger, completeness, yeah? So moving forward, completeness and accuracy, moving backwards, you want to confirm that. So this is so simple and interesting. You just have to know the documents, move forward with them, then just reverse the same to test for occurrence. Then some sales are not credit. Now, for these ones are for credit sales. Yeah, we go to runs for cash what? Sales. For cash sales, you start from the cash book. For example, if you want test occurrence, cash book. What was posted in the cash book? Remember, cash sales will debit the cash book, credit the sales. Start from the cash book, pick those sales in the cash book, agree them to the receipts. There should be a receipt. There should be a daily sales report or a till roll. Like in supermarkets, they have till rolls. Till rolls, not those rolls. They remain with copies, the ones they give you. Deposit slips in the bank, because some customers pay through the bank, they don't pay. So you may not have receipts. They may have paid directly in bank. So what is in the cash book? Is there source documents for it? Because if there's no source document, that's evident that they just posted in the cash book, the transaction never occurred, they just put in the cash book, but there's no any source what? Document. That's why we are testing for occurrence. So from cash book to receipt to deposit slip, yeah? Then we reverse this. You can also reverse this test for completeness. You can start from the receipts and check whether all the receipts have been posted in the cash book. That we test for completeness. And then agree a sample of customer orders, the GDNs, sales invoice, and check the invoice is posted in the general ledger. Still, this one is the same or almost same as the first one. What we are adding is the what? The customer what? Orders. Still testing. You see, we are moving forward. This is testing for completeness. Then you can also trace a sample of cash. This should be a different test. Trace a sample of cash receipts, the sales and cash accounts in the general ledger, and bank statements verify completeness of sales. So from receipts to cash to the ledger accounts, and then bank statement to verify completeness. Then we're also going to verify the quantity of the amount sold. So you get the invoices, check them with the journal, and then the invoice from the journal, and agree the quantity and description of the goods invoice, the GDN. So from invoice to GDN, and then the price list, you're moving backwards to, and then you calculate. What do you calculate on the invoice? You can recalculate the discounts, the VAT, so this is a recalculation. So on the invoice, what do you recalculate? We can recalculate the VAT, we can recalculate discounts, we can recast the transactions, you get it. And then credit for sales returned. Some sales are returned by customers. What do you do? Which documents do you inspect or do you check? For returned goods, you're going to select a sample of credit notes, because the credit note is prepared when goods are returned by the customer. So select a sample of credit notes and inspect them with the goods received notes, because when a customer returns goods, we record them in a goods received note, but we issue that customer with a credit note. So to ensure that all goods that are returned, we have issued them with credit notes, we're going to get a sample of credit notes raised and match them with the goods received notes for sales returns. And these sales returns in the ledger, now you go to the ledger, they should have been removed from the ledger, the returned goods. They should be, remember, for good, when goods are returned, we debit the return inwards. We debit the return and credit the data, yeah? Debit returns inwards, credit the data. So in the debtors account, have they credited? Then have we debited the returns inwards? Like that. Then for cutoff, we are going to select a sample of GDNs before and after year end. Those GDNs are the documents that sell goods. Ensure that they are recorded in the right what period. If a GDN was issued on 1st January, meaning that sale is for the new year. But if a GDN has 31st December, then it is for the current year or for the previous year. Also check for proper classification of the sales on the chart of accounts. There are different accounts under sales. The sales account, have they credited it with all the sales? If there's interest, if there's dividend income, have they separated them from sales? And then you also check for proper presentation of sales in the accounting policy. So which tests have we used here? We have used the analytical procedures. We have used the recalculations. We have recalculated the prices on the invoices, the VAT, the discounts. We have done inspections. Most of them are inspections of documents. So analytical procedures. We have done analytical procedures. We have done we have done recalculations. Then we have also had inspection of documents. Major doses. We don't have inspection of assets because in sales there's no any asset. A sale is not an asset, it's an income. We have not done external confirmation. It doesn't come for debtors. Then we have not done. If you want, you can do inquiries, but major these are the ones which we have done here. So it's all about you knowing those documents which you are comparing, which you are agreeing, which you are matching. So any question on audit of sales? Cutoff, we have said you compare, you review the dates of the GDNs before year end and after year end. Confirm that the GDNs raised in the new year are recorded as sales for the new year. The GDNs issued before year, right after year end. The GDN now, which GDNs confuse people? Those issued just before year end or those after year end? You sell goods right after year end before the auditors come. So you may think it's a sale of the previous year, yet it's for the current year. Or you sell goods right on 31st December. Also, it confuses people. Somebody buys goods on 31st December, you issue a GDN, but he picks them on 1st. The invoice is on 1st. So if I ask you a question, if the GDN has 31st December, the goods dispatch note, but the invoice has 1st January, where does that sale belong? GDN is 31st December, invoice is 1st January.
It belongs to the previous year.
So it is for the previous year. So that is what confuses people. That's why we say, you as an auditor, you look at the dates of those documents, select a sample of GDNs before and after year end, inspect the dates on the corresponding sales invoices and the dates they were recorded in the receivables ledger to ensure they are recorded in the correct accounting period to verify cutoff of sales, like that. So you don't follow the date of the invoice. Invoice is just a document which claims for money, but a document which sells goods is the GDN. We go to the next part, which is audit of receivables. Now for receivables, we are still going to use our normal tests. So before we look at what we have here, can we start with analytical? Under analytical, can somebody give us a test under analytical for receivables? Then from analytical, go to calculations. We go to, before you read what is in the notes, I just want us to brainstorm. Tests for receivables, we start with analytical, we go to recalculation, we go to external confirmation, we go to inspection of documents. Yeah. Yes, I'm waiting for your contribution. We are starting with analytical procedures. What do we compare on receivables? Can somebody unmute and talk or type in the chat room? Yes, Barbara?
You compare the amount of payments the previous years.
With what?
Excuse me.
Yes.
I think we compared the revenue with
No, we are in
the
receivables. Receivables.
yes, and the revenue with the receivables. That is
The
what I'm
revenue is
thinking.
receivables.
We can inspect the supporting documents of that is goods delivered, not GDNs, with the example of receivables.
No, don't mix this thing with sales. We are on receivables. Somebody is saying compare the payment days of receivables for the current year and the previous year. Then to do what? You have not completed that test.
Excuse me, sir.
Yes.
I think for receivables, receivables, they are like data. They come from credit sales.
Yes.
So we compare the credit sales of the current year with that one of the previous year.
You people are all beating around the bush. You can compare the total receivables for the current year with the previous year. We started with the total. What are the total receivables? Current year, previous year. And investigate the significant fluctuations or increase or decrease. Compare total trade receivables or receivables for the current year with the previous year. And investigate any significant changes to verify. Here we are verifying COVEP, for example, to verify completeness and accuracy of receive. So total, you start with the total. If receivables are increasing, then there's a problem. There might be a problem with the credit policy. Our credit policy is too lenient. You started that in FM. So that's why the receivables are increasing. And we are going to have a problem of bad debts. So as an auditor, you advise that if receivables are increasing, that's an indicator that in the future, the bad debts will be high. So start with the total receivables for the current year and the previous years. If there are significant changes, it's an indicator that the risk of material misstatement due to bad debts is likely to increase. Yeah. But again, if receivables are decreasing hugely, then there's a problem also. maybe the company is becoming strict with its credit policies, which may chase away some customers. So these investigate what is causing them. If the causes are genuine, it's okay. But if the causes are questionable, then you raise your voice over them and they possibly revert and do the best practice. Then I said you also compare a ratio, if there's a ratio. Which ratio is under here? Somebody was typing receivables days, receivables collection days. That's the ratio. Somebody was typing payment. Is receivables collection period with the previous years and investigate any significant increases, verify existence. If the receivables days are increasing, does that data still exist? Or is it completely recorded? Have they added the interest they're charging that data? You get it? So collection period. Or it can be inventory turnover rate, yeah? Like that. But also, we can also compare receivables. If you have branches, receivables of branch A, branch B, and the other branches, which branch is having more receivables, and what could be the reason? You get it. Then you can go to, what do you calculate here on receivables? For example, you can show the bad debts written off. You can recompute the receivables amounts and all that. You can go to external confirmation, obtain confirmations from selected receivables. Like those high values, you get it, high value receivables. You can get those with high amounts, you get it, high amounts. Then those who have taken long without paying, the aging ones, aging receivables. You select a few, like those who are aging, those who have high amounts, etc. Confirm their balances. And yeah, basically confirming balances and existence. That will be external what? Confirmation. Then you can go to inspection. Now, on inspections, which documents are you going to look at? You're going to look at the one receivables schedule. You're going to get the schedule of receivables, all this. You can develop it yourself or they can develop it for you. You're going to get the invoices. These are documents you're going to compare. Invoices, GDNs, ledger, receivables ledger. Then there's also the statement of financial position, etc. Those are some of the key ones. Yeah. So, for example, if you're moving forward, you're going to start with the source documents like the invoices and the GDNs, trace them to the receivables ledger. You want to make sure that all the goods sold on credit have been recorded in the ledger, and the statement of financial position, that the total in the ledger is the one that is in the balance sheet. But also you can get this schedule and check whether it is the schedule. You can match the schedule with the invoices. Because to come on the schedule must be a credit a data or a credit sale. Yeah. So these are the documents you're going to play around with, agreeing and comparing and matching. Yeah. So we look at these tests. Like for completeness, you're saying agree a sample of balances from the ledger to the age receivables list. You get it. Aged receivables, this is the list I'm talking about. You create the list of people who have not paid. Aged receivables, those are debtors who have not paid in their required time. If you give them 60 days, they have not paid in those 60 days. The person who doesn't pay in the allocated credit period, he or she becomes a credit and aging what? Data. So create their list, those aged receivables, to confirm that they are actually existing. Start from the ledger and then compare with the list. They must be on that list. So the list comes after the ledger. You first have the ledger, then you create the list. The list is created from invoices, basically. So you want to make sure that all of them have been included on the list. Then cast the aged receivables list, meaning you add it again, or subtract, you just add it again and agree the total of the receivables ledger, control account, trial balance, and statement of financial position. You are moving forward still from ledger to list to trial balance to balance sheet. Then agreements. You have agreements with your debtors. We inspect these agreements and then make sure that in case there are prepayments, remember we're auditing debtors and prepayments. So agree the list or inspect the lists. Inspect the agreements with third parties and compare the amount of prepayments to the previous year. A customer might have prepaid you. So there's an agreement. Whenever you prepay somebody, there is an agreement. So that agreement must be showing how much amount has been prepaid. And it must be matching. For of course, he prepays in the previous year. So if previous year he paid 1 million and the prepayment is 200 out of that. So we're going to go to previous year. How much did he pay? Did he pay higher amount, which is bringing that what? Prepayment. So to prove that, you look at the agreement, sales agreement, find out how much was he supposed to pay and how much did he actually pay. If he paid more, then that is a prepayment. Existence, you're going to obtain confirmations from these debtors. If they reply us, then that will be evident that these debtors do exist and they know their debts and they're going to pay. But in some confirmations, you find disagreements. You, the auditor, you write, you say, I'm auditing ABC Limited. You are a debtor here. Your debt is 1 million. Is it true that it is 1 million? Then the person will reply and say, no, it's not 1 million. I already paid those people all their money. They don't demand me anything. And he even attaches evidence that he paid. Now, those disagreements, you're auditing them. So what do? You perform alternative procedures for balancing disagreements and non-replies to receivables confirmation. Sometimes you write and they don't reply. So you can go back and if the data is saying he paid, go back to the bank statements, to the cash receipts, because the data will have sent you the evidence that he paid. He will send you a receipt, for example. Go back in the receipt book and look at the duplicate. Is it there? If it is there, then they paid and they received the cash. Maybe they haven't just updated the what? The ledger. Then you can also look at the supporting documents like invoices and GDN to see what was the original amount. Has he paid all of it? You can also review the correspondences between the customer and the business. Correspondences can be in form of emails, letters they have been sending to each other. They will show whether the person has paid or not. For example, they might have sent him an email demanding the money 1 million, but he has only paid 800, meaning they still demand him 200. So correspondences are the communication between the data and the business. You review them and they will confirm to you whether the person has cleared this balance or not. And all those other ones. Also review review the aged receivables list for large and unusual receivables. On this list of receivables who have not paid their money in the allocated time, some amounts may be too large and they are worrying. They may anytime become bad debts. So you review them and get more information from the management on how they are handling, on how they are collecting that money. That will also, you can even write to these people with large amounts and unusual balances, confirm their existence. So existence is mainly through confirmations, but also reviewing these other documents can confirm existence, like the source documents, like the bank statements. If somebody is already paying money through the bank, that means he exists. If they are source documents, that means it may be existing. If they are correspondences, people are saying they are talking, they are communicating through email, through letters, that is evidence that the customer is actually there. Then rights, do we have rights over these data? Do we own them? Are they ours? We look at the source documents. Provided we have the invoice, we sent them invoices, send them GDNs, there's a contract. It is evidence. Then sometimes we review bank confirmation for any liens on receivables. Sometimes you find that the receivable is was, for example, got a reference from the bank. Before you sell goods, some receivables, you ask them references like from the bank. So if a bank gave them a reference, for example, that is confirmation that you obtain confirmation from the bank, which was a referee of this data, to confirm that whether he's still their customer. If he's still there, then you have rights over them. And then also inquire from management. You can make inquiries on whether they actually own these data and they're theirs. Then evaluation and allocation, this will look at the days, compare the receivable days with the previous year to investigate any differences. If there is a provision for bad debts, check whether it is adequate. You can check with the company policies and other guidelines. If they have given 5%, is it adequate or it is not adequate? Is it overstated or understated? You can check with the previous year how many failed to pay the previous year. For example, if you're in banks, there's a guideline by Bank of Uganda on those provisions and how you should allocate them. Correspondences can also help in knowing the actual value. The communication between the customer and the entity shows the actual value that is pending. Because we shall send him a letter saying we demand you 200. So it will be evident. Then compare the bad debts of the previous year with the current year and industrial average to also help us know the value of the bad debts we are anticipating, whether it's correct or not. If it's far away from the industry, then it may be overstated. For bad debts written off, there must be a confirmation from the board. So review board minutes to approve of writing off the bad debts. Then for now, some debtors pay after the year has ended. The year ended 31st December, but the data brings the money on 5th January. So if they don't go back to update the list, then there will be a problem. They will be showing him as a data, yet the person paid what? His money. Yet the person paid his money. Somebody wants to the meaning of lien. I said that lien is all about some debtors go to the bank. The bank acts as like their guarantor, you get it? So lien means in law, it means the right to keep possession of property belonging to another person. You're keeping property belonging to another person until debt owed by that person is discharged. So some debtors may use security. A customer wants to buy goods on credit, to ask him security. So that security is kept by the bank. He deposits it with the bank. In case he fails to pay, you interact with his bank and you sell that security to get your money. So imagine a debtor wants to buy goods from you on credit. You ask him security or collateral. He puts his land title, but that land title is kept by his bank. You get it? So to confirm that that debt exists, we shall write to the bank. We say in the agreement here, we see that you, the bank, you were the guarantor of this customer, and in lien you kept his land title as security, and you only return it to the customer if he has paid all his balance. Is it true? When the bank agrees, then it is evident that that debt exists. So lien just is all about right. It's a right to keep property of another person until that person pays his money, and then the property is returned. And those properties are normally kept by the bank. And so that is the audit of receivables. Then final, as we end, we say that you write confirmation letters to the receivables, but how does a confirmation letter look like? It's like any other letter, and it has a standard 505, ISA 505. Permission, you must get, we said that you must get permission from management to write to their customers. And you must, in that letter, you put the reasons. Yes, the banker is just keeping the property. Then after the data has cleared this balance, they return the property to him. The customer may not be confident keeping the property with you. So he deposits with this bank. So the three of you agree, you, the bank, and the customer. So he keeps it as collateral, yes. Then when he pays all his money, the bank returns the property. So what do we put in this letter? We would put the reason. We said that we need to first get permission from, if you're auditing, say, if you're auditing Mukwano Industries, you first write to the CEO, say, I want to talk to your receivables. I want to write to them to get some information from them. The CEO must allow you to write to his data. But when the letter is coming back from the customer, it shouldn't pass through the CEO again. It should come direct to the auditor. Because if it passes through the CEO or management, they can alter it. So ask permission from the management of the client you're auditing. They allow you to write to their customers. Then, but request the customers, send the letter directly to the auditor, not to management again. So you don't be like in the Bible, like the wise men, they told them not to go back to Herod, you get it. So you also tell the customer not to pass the letter to Herod. It must come direct to you, the auditor. But you writing to them, you get permission. But sometimes the management rejects your permission. You ask them, I want to write to your customers, and they refuse. What do you do when they refuse? You must establish the reasons why they're refusing you from consulting from their customers. You must find the implications of the refusal. If they refuse, can't you verify these things using alternative audit procedures? If you find that you can't, you really want to talk to the customers, then you find something else to do. You can do alternative procedures if they refuse, like analytical, like reconsideration, and others. But also, if the implications are so grave and they may limit the scope of your audit, then you may also have to discuss with the board. Tell them that management rejected our proposal to write to the debtors, so we can't confirm the balances of the debtors. So it can be put as an exception in your report that actually we didn't confirm from debtors because management refused. There are two types of letters we write. The first letter is the positive confirmation. Now, the positive confirmation is a letter you write to the debtor, asking them to respond. Whether they agree or disagree with the balance, they must respond. That's positive letter. Whether they agree or disagree, they must what? Respond. This is normally for big amounts or where you have seen a high risk. You're going to ask them, you must respond whether you agree or disagree with the balance. But negative letter, you only request them to respond if they disagree with the balance or if they have any issues. But if they agree with the balances, then they don't respond. You ask them to keep quiet, remain quiet. Positive letter, they must respond whether they agree or disagree with the balances. Negative letter, the auditor requests the client or the customer to only respond if he disagrees with the balance. So negative letter is normally written when the risk is low. The balances are small, the risk is likely to be low, then you can request for a negative letter. So but the only challenge with negative letter is the letter may not have been received by the client and he doesn't reply. So you assume that he agreed with the balance. So that's what I'm talking about. I'm not getting your question. There's a person who has it. Sir, which are these people to agree? Agree on what? I'm not getting the question. So this is the letter
on positive.
on the positive.
Yes.
Those are the debtors, whether they agree or they disagree. The debtors, the customers. You get it? You're
Yes.
writing to a customer to respond whether he's agreeing or he's disagreeing or the data. Yeah. Or if you're writing to the bank, it is the bank. Or it can be a creditor, you get it? That external person you have written to. I shared the notes. Irina and Nancy, Irina, I shared the notes. You have the notes on the platform. So this is a sample of the letter. You read through it in your free time. So there's a question here you can look at. Next time we meet, you're going to start from audit of bank. That will be when? Is it on tomorrow? Yeah, tomorrow. Tomorrow we shall start from 5.6, which is the audit of bank and cash. So enjoy the rest of your day.
Thank you so much for watching. Make sure you subscribe to the channel.